Welcome back to We Get Mac. We're going to continue to learn about monetary policy. So like I said, we're going to focus here on the main function of the central bank for this chapter, that is conduct monetary policy, which of course is going to connect with its idea of guaranteeing or trying to guarantee a more healthy and stable banking system for the U.S. Okay, so that's their goal. So this has been a function of the Fed since 1913, since it was established. Okay, and the idea that it could regulate the economy through the value of the coin. Okay, so there's different ways which the central bank uses its power to do so. We're going to talk about two: traditional monetary policy tools, and then we're going to talk about modern monetary policy tools, which will come post the Great Recession of 2007. And we're going to discuss the reasons why all that happened and why they had to create new types of tools. Okay, but right now, I really ask you that stop the video right now, go to your slides that you downloaded from your campus or Top Hat, and click on the link to watch this video, because I'm gonna continue the class hoping that you guys watch these videos that I'm gonna propose throughout this chapter, because they're extremely helpful. Okay, so please take a time and pause the video and do that now. All right, so hopefully you did that, and now going back to our discussion of it, as you saw, there's a lot of different ways to do so. We're going to talk about it one at a time, but the main idea here is that the main one, the most traditional type of monetary policy tool, it is through open market operations. Okay, so the FOMC, the Federal Open Market Committee, they meet and they make decisions about what's going to happen with the economy in terms of interest rates. So those open market operations here, they include the buying and selling of U.S. Treasury bonds to commercial banks in exchange for more reserves, and that would alter the cost of borrowing due to the higher or lower availability of money in the economy. So they're going to control the money supply, right? Which then would alter interest rates, and these interest rates would then impact the economy through changes in investment and consumption, which we're going to connect through our aggregate demand model. Okay, so that's the idea here. So to do so, we're going to have to kind of have a target rate, which you saw in the video, which is the federal funds rate. So based on the Federal Reserve is going to target the federal funds rate, say, hey, it should go up or should go down. That will give us an idea about where the economy is headed and what they wanted to do. If they want to stimulate economic growth, or if they want to pump the brakes and say, hey, we're growing too fast, let's control this. Okay, so hopefully now you're gonna get to make sense about when somebody talk on the news, hey, the Federal Reserve increased interest rates or lowered interest rates. We're going to be able to expect what's going to happen in terms of inflation, unemployment, and changes in economic activity in the economy. Okay, so hopefully that will get you super interested, because that's going to be important in your life, right? Imagine you own a business. You definitely want to know how the economy is doing and whether the central bank is providing more funds for people to borrow money, which can increase demand, aggregate demand, right? Or if they're making loans more costly, which should stop people from borrowing money and change decisions towards consumption. Like if the interest rate is higher, maybe you choose towards saving instead of paying a higher interest rate on your loan to be able to get that loan, right? So those are all the things we're going to be able to connect here. Okay, so the idea here is that this federal funds rate is very short term, and it's the rate that banks charge one another for overnight loans. So if they need to borrow money to meet their reserve requirements, for example, they go to the other bank and ask, oh, wait, but didn't you say that the central bank was the lender of last resort? They prefer to go to other banks first, right? Do you go, if you're in trouble, and I guess we all have gone through this, and when if you ever need a little bit of money, you go to your friend and say, hey, can I borrow money for you? You don't go to your boss and say, hey, can I borrow money from you, right? So your boss would think that you're not doing a good job and you don't know how to manage money, and maybe that can reflect bad on you. So that's the idea here. They don't go to the regulator, they ask their friend before they ask the regulator. Okay, and given that they can alter the interest rate, the cost of those loans between banks, then the idea is that short-term interest rate reflects the economic situation of the economy, current credit conditions, and by altering that would eventually cause all interest rates to alter. Okay, of course, longer run interest rates are a lot harder to be controlled, like we talked about, because there's a lot more factors that can change in 10, 15 years than in the short term, right? But the idea is that change in the short term would lead to change in economic activity, okay? And we're going to be able to connect how this is done by following a couple of graphs, which I think is going to be very helpful. So the idea here, and as you can see here, this is the change in the federal funds rate over time, okay? So through changes in the money supply, the Federal Reserve can indirectly manipulate changes in economic activity, okay? That's the theory. Okay, so the idea here, let's focus on something that we're experiencing right now. So we're currently experiencing the pandemic, And let's focus on how could then the central bank stimulate the economy to grow. Okay, so the idea here is that we want to make sure that we want to stimulate the economy to grow, which if you think about it, and I'm gonna draw it here, we're talking here about the aggregate demand and aggregate supply model, where we have short run aggregate supply, we have long run aggregate supply, right? And if we're in a recession, we have aggregate demand a little bit further, right? So you can see here there's GDP gap that is negative, which means unemployment is higher than the net rate of unemployment. So there's more people unemployed in the economy than we want, right? We know that the efficient level would be to stay where the long run aggregate supply is, or potential GDP, as we talked about before, right? So one of the ways that we can see the economy being able to achieve higher outcomes would be through allowing more, making it easier for people to get loans, right? Why? Because if you remember here, the idea is that the aggregate demand equals to the GDP equation, as we talked about before, right? And that's equal to C plus I plus G plus NX, right? If you imagine that now it's cheaper to get loans because there's more money available in the economy, and that's the idea that we're going to translate to those graphs in a second, right? Then we know that, hey, if it's cheaper to get loans, maybe now I'll go get that house that I wanted. Maybe now I'll go get that car that I wanted. And that depends on that mortgage, or depends on that car loan. Or maybe I just start spending more money because I get more confident there's more money in the economy. I'm able to find money more easy, right? The economy is going to grow. And that leads to more investment and more consumption. That's the idea. Loans are cheaper, firms can invest more, householders can borrow that money to invest in durable goods. And if that increases, that will lead the aggregate demand to start shifting to the right, okay? So that's the idea here. And if that's the case, you can see here, we can start seeing some predictions, right? So Ed, is this perfect? It's always going to happen? No, we're simplifying a problem that is real to try to draw out some implications of what we can expect based on economic theory, right? So that's the idea here. So based on a stimulus from the central bank, an expansionary monetary policy, and of course we're going to dive into this one at a time later. We're just giving a quick preview about why this is so important, right? We know that could stimulate the aggregate demand. We could shift the aggregate demand to the right. If that's the case, we're going to see an increase in output, right, from Y1 to Y2. And we're going to see potentially an increase in the price level from P1 to P2, right? So you can see, hey, it's really important to grow the economy because we want to get more output. But at the same time, we need to be careful because, hey, inflation might kick in. So you can see the two words of the central bank, which if you remember, the main goals are, hey, make sure that the economy is stable, low sustainable inflation, and full employment economy, right? That's the idea here. So we're trying to achieve the full employment economy by lower the GDP gap, right, to zero. And at the same time, we're trying to make sure that prices don't go up too much. Okay, so that's the idea. Let's see how that has been working out so far. Okay, so if we go back to the graph here, an expansionary policy, and we're going to go through those all in a lower step, would be the idea that, hey, central bank wants to increase the amount of money in the economy, right? Because if they increase the amount of money in the economy, the idea is that the supply in the loanable form markets will go up because banks will have more reserves to lend out, right? Which will lower the cost of borrowing because now banks have more money to lend out, so it's cheaper to borrow money. That's the idea. Okay, if that's the case, the amount of loans and investment will go up, which leads to more consumption and more investment, right? If that's the case, the aggregate demand goes up, and that will lead to economic expansion, as we saw on the previous slide. Okay, so let's see if that's the case. Let's get, as you know, the shaded areas here, they're recessions. Let's see how that works out. Okay, so during a recession, let's say the 2001 right here, we see here that the economy hit a recession, which means GDP is going down, right? Which means the economy needs help, right? So do we see a drop in interest rate? Does the central bank react by targeting a lower interest rate? And you can see that, yes, you can see a drop in interest rate here, right? This is because the central bank is increasing the money supply through monetary policy, right? Which is lowering the interest rate. So they're indirectly impacting the market. They don't directly change the interest rate. They impact the money supply, which then impact the market for the federal funds rate, right? For the overnight loans among banks, which leads to changes in other interest rates in the economy, which leads to higher loans, higher investment, because now it's cheaper to borrow, right? and that leads to higher aggregate demand, which will lead to GDP growth, right? So eventually we should see in the future, in the next slides, we're going to go through GDP and inflation, is that during the 2000s, we expect to see GDP increase due to the response. So we're talking here about 2001 and 2, and we should see price levels increase. So let's see if the theory works, okay? So this is a real GDP per capita, change in a yearly change. So the growth rate, and here's 2000, right? And you can see that the economy was going down, and you can see that around that time, that's when the Federal Reserve was lowering interest rates. So it took a while for that to change the economy. So as you can see, there's a lag when policies implemented to when you see the impact on the economy. But yeah, you can see here that it had an impact. Eventually, when aggregate demand picked up and people actually started getting more loans, and there's other policies to consider as well, but you can see here that it seems that had an impact on the economy, right? It seems like it's bringing out GDP. Okay, so you can definitely go by yourself on the slides and see if that works for other recessions as well, which I really incentivize you to do. But for the time, for the purposes of the restricted time that we have on the videos, we're just gonna do in this recession. Okay, so what about the price level? Did we see price level increases? Well, that's the part that this theory is not perfect, but it does give us some idea, right? So you see here that the price level did pick up a little bit, but not too much, right? So you can see the stickiness of the price level in the economy that we have discussed is inflation. So the central bank makes sure that we're growing, but as you can see, they really focus on controlling inflation. So we grew, but maybe we could have grown faster, but at the cost of higher inflation. And maybe the central bank opted out for a slower relative to what it could have been, but more controlled inflation recovery, okay? So that's the idea here. So now we're gonna invest into these different types of tools and how this is done by first talk about the Federal Open Market Committee on the next video. So stay tuned.